Ottawa has unleashed a forceful response to U.S. President Donald Trump's steel and aluminum tariffs by imposing a 50% retaliatory tariff, striking at the very core of North America's vast and interconnected supply chain network, a critical economic lifeline for both nations. This bold decision threatens to immediately inflate costs across the automotive and beverage container industries, spanning from Detroit to Vancouver, potentially disrupting a vital artery of cross-border commerce. If Washington refuses to back down, the industrial heartlands of the United States and Canada risk plunging into a synchronized recessionary downturn, threatening economic stability and regional prosperity. Will Prime Minister Mark Carney's resolute stance undermine the long-standing U.S. Canada alliance? Or will it compel Washington to return to the negotiating table to resolve this escalating trade conflict? We will delve into the intricate details of these unfolding global developments, examining their far-reaching implications. Be sure to subscribe to our channel and like our videos to stay fully informed with our comprehensive coverage. A high-stakes cabinet meeting held in the Rayo wing of the Prime Minister's office in late June, initially anticipated by Ottawa journalists to yield a routine press release under the innocuous headline, "Energy Transition Plan," concluded with a shocking leak that sent shockwaves through financial and political circles on both sides of the border. Carney had granted the Treasury and Trade Secretaries full authority to prepare a robust retaliatory strategy against Trump's steel and aluminum tariffs. Within hours, major news outlets such as Reuters, Bloomberg, and Yahoo Finance confirmed Canada's audacious plan to impose substantial tariffs on approximately $22 billion worth of U.S.-sourced semi-finished metal imports annually, capped at 50% under a temporary regulation set to be formally unveiled in mid-July. Trump's March decision, widely regarded as the most aggressive trade move since the establishment of the North American Free Trade Agreement, introduced a 50% tariff on Canadian-origin hot-rolled steel, aluminum profiles, and raw materials used for pressurized beverage cans, justified under Section 232 on national security grounds. Leaked internal memos from White House advisors revealed that Washington's primary objective was to block Chinese-origin steel from entering the U.S. market through origin switching via Canada, a practice that allegedly undermines American industrial interests. However, the Carney administration swiftly dismissed this rationale as protectionist, rooted in flawed datasets that overlooked the true carbon footprint of production and unfairly penalized supply chains within the same allied economic bloc, straining the trust built over decades of cooperation. Ottawa's initial response in April was cautious and calculated, with the federal cabinet announcing a $3.5 billion Industry Transition Credits Fund, designed to provide zero-interest cash flow support to key producers such as Stelco, Algoma, Rio Tinto Alcan, and ArcelorMittal Dofasco to mitigate the tariff's immediate financial impact. By the end of June, however, this buffer proved woefully inadequate, as the U.S. 50% tariff had driven the price of Canadian-origin hot-rolled coil $38 per ton above the spot price of Chicago futures contracts, creating significant cost pressures. In Alberta, oil pipeline construction projects critical to the energy sector, an Ontario automotive chassis supplier integral to vehicle manufacturing, and a British Columbia aluminum beverage compress line essential for packaging, faced severe financial strain, forcing these industries to resort to substantial Bank of Montreal loans to address urgent cash flow demands triggered by skyrocketing inventory costs. Mark Carney's ambitions appear to extend far beyond merely imposing a retaliatory tax on metals, signaling a broader intent to redefine the cross-border supply chain, long considered an untouchable pillar of North American economic integration and prosperity. Sources close to Carney highlight his data-driven approach, honed during his tenure as Governor of the Bank of England, which led him to demand, within a mere 48 hours, detailed information on steel casting locations, hot furnace chemistry certificates, and carbon isotope analysis to trace the origins and environmental impact of production. This meticulous effort aims to dismantle Washington's national security argument by precisely documenting where steel is cast, the scrap materials used in its production, and the associated carbon emissions profile, thereby exposing the weaknesses in the U.S.'s justification. Carney did not hesitate to leverage this data as a pretext for retaliation. The carbon footprint of American-made steel pipes is significantly higher than ours, while our production methods are cleaner and more sustainable. So the burden of passing these inflated costs to consumers falls squarely on the United States. The origin of the 50% tariff idea can be traced to a shock simulation commissioned by Finance Minister Chrystia Freeland in late April, designed to model the economic fallout of Canada's response. The simulation revealed that a 50% Canadian import tax would increase the cost of U.S.-made raw steel coils by at least 420 Canadians per ton, resulting in an average cost hike of 850 Canadians per pickup truck and SUV manufactured in the Detroit-Toronto automotive corridor, a critical hub for North American vehicle production. A pivotal finding was that automakers would likely pass these costs onto consumers, meaning the profit margins of vehicles manufactured in the U.S. and sold in Canada, rather than Canadian consumers directly, would bear the brunt of the financial impact, strategically shifting the economic burden southward. In essence, Carney sought to counter Washington's national security claims with a multifaceted response prioritizing consumer welfare and exposing the flaws in U.S. trade policy. The retaliatory tariff sparked significant market turbulence, not only in bilateral trade but also on the global stage, with the London Metal Exchange witnessing a surge in cold-rolled steel futures contracts by $60 per ton within a week of Canada's announcement, reflecting heightened market anxiety. Aluminum 3-month futures contracts breached the $2,540 per metric ton threshold, reaching an 8-month high and underscoring the fragility of global metal markets. Morgan Stanley analysts interpreted this price volatility as a resurgence of supply security concerns, absent from the market for 6 months, driven by Canada's critical role as a leading supplier of low-carbon aluminum ingots, powered by clean hydroelectricity in North America. These Canadian ingots are indispensable for the carbon footprint reports of U.S. New England region beer can manufacturers and automotive giants like Tesla, whose sustainability commitments rely on low-emission materials. A disruption in this supply chain could significantly elevate carbon compliance costs, potentially leading to unexpected shortfalls in Inflation Reduction Act (IRA), undermining U.S. environmental and economic goals. The Canada Border Services Agency's impact assessment painted a grim scenario. If the U.S. loses access to Canadian aluminum, it would likely turn to castings from distant markets like Australia or Gulf countries, which involve higher transportation emissions and longer supply times, further deteriorating the U.S.'s carbon balance and complicating its climate commitments. In short, Carney is strategically leveraging both commercial and environmental superiority arguments to pressure Washington through a calculated retaliatory approach. Ottawa's strategy extends beyond tariffs, incorporating a comprehensive domestic resource enhancement package to bolster its industrial sector. A leaked draft from late June revealed a CAD-D Green Steel Accord Fund, backed by a credit guarantee from the Royal Bank of Canada, to be distributed through a combination of tax credits, capital grants, and low-interest loans. These funds' engine will support transformative initiatives such as the conversion of ArcelorMittal Dofasco's electric arc furnace in Hamilton, Algoma's hydrogen direct reduced iron pilot line in Sault Ste. Marie, and the innovative inert anode project at Rio Tinto's Alouette smelter in Quebec, all aimed at enhancing Canada's low-carbon production capacity. Carney's approach is clear. If the U.S. tariff wall creates short-term economic challenges, Canada will seize the opportunity to invest heavily in sustainable, low-carbon industrial infrastructure, positioning itself as a global leader in green manufacturing. While Trump's economic advisors dismissed the move as a technocratic financial maneuver designed to outsmart markets, Republican lawmakers like Wisconsin Senator Bill Hagerty raised urgent alarms, stating, "Canada is our top partner in agriculture, energy, and metals. A cycle of retaliation may score short-term political points for the White House, but in Detroit, it won't just be unions. It'll be CEOs as well, demanding relief." Internal reports from industry giants Ford and General Motors indicated that a 50% tariff on thick steel plates from Canada would erode vehicle profit margins by $320 per unit, translating to a staggering $45 million loss over a single model's lifetime, threatening the competitiveness of American automakers. The International Institute of Finance's report, titled North American Trade Tensions, published in late June, estimated that a prolonged tariff war on steel and aluminum could reduce GDP growth in both the U.S. and Canada by 0.3 percentage points by 2026, a seemingly modest figure that compounds existing pressures on the U.S. economy from rising interest rates driven by Trump's stimulus-fueled inflationary policies. Canada, however, can partially mitigate the impact through its robust energy export surplus and a weaker Canadian dollar, which provides some economic cushioning. Nevertheless, the IIF warns that retaliation risks could shave 0.4 percentage points off Canada's GDP growth through the net export channel, highlighting the high stakes of this trade dispute. Carney's political strategy hinges on securing robust support from the NDP and Bloc Québécois in the federal parliament, ensuring a broad domestic coalition to back his aggressive trade stance. Conservative leader Pierre Poilievre sharply criticized Carney for destabilizing what he calls the beaver economy by countering protectionism with protectionism, arguing it risks long-term economic harm. Yet, public opinion paints a contrasting picture. Recent Abacus data polls reveal that 61% of Canadian voters support equivalent retaliation against U.S. tariffs, with support surging to 68% in Ontario's industrial belt, a region heavily impacted by trade disruptions, indicating strong domestic backing for Carney's counter-tariff plan. Ottawa faces a complex dual challenge, responding decisively to Trump's tariffs and safeguarding its steel and aluminum industries, while preserving Canada's reputation as a stable and reliable hub within global supply chains. To navigate this contradiction, the Prime Minister's Office of Economic Affairs introduced a strategic tariff ladder formula during discussions on the sidelines of the G7 finance meeting in London, proposing a 50% tariff cap that would be gradually reduced every 3 months if the U.S. scales back its Section 232 tariffs, offering a clear de-escalation pathway. This approach diverges from the Trudeau government's 2018 response, which imposed a 25% tariff that was lifted following the conclusion of USMCA negotiations. Carney emphasizes that repeated tit-for-tat trade measures have eroded bilateral trust, necessitating a robust justification for new retaliatory actions, potentially escalating the dispute to the World Trade Organization's Dispute Settlement Panel. CBSA lawyers have meticulously prepared a draft complaint alleging that the U.S. is misusing Section 232 on national security grounds, ready to be filed in Geneva once the tariff decision is officially announced. Canada's tit-for-tat strategy is drawing close scrutiny from major trading partners like Tokyo, Seoul, and Canberra, as the U.S. has imposed similar Section 232 tariffs on South Korea and Japan with quotas, while notably exempting Australia. A successful Canadian retaliation could embolden these nations to adopt symmetric responses, particularly in Japan, where costly raw material imports and significant automotive exports heighten vulnerability to U.S. trade restrictions, threatening both production and refinery investments. For now, Canada is deliberately avoiding extending tariffs to automotive, agricultural, or technology sectors, exercising caution due to the critical importance of its energy exports. 69% of Western Canada's crude oil flows to U.S. refineries, underpinning billions in swap agreements that are vital to the nation's public finances. Industry support for Carney's strategy is robust and widespread. United Steelworkers Canada President Marty Warren labeled Trump's tariffs a betrayal of workers, praising Carney's response as overdue but justified, while the Quebec Aluminum Association reported staggering losses of 280 million Canadas from collapsing margins on raw block sales to the U.S., underscoring the urgency of the aluminum shield. However, some importing sectors are sounding alarms. The Brewers Association of Canada warns that a 5-cent increase in aluminum can prices could prove catastrophic for the craft beer sector, potentially forcing small boutique producers to lose valuable shelf space in a competitive market. To mitigate this risk, Carney is actively negotiating partial tax exemptions based on historical quotas for high-volume beverage producers, such as Danone, Coca-Cola, and Molson, aiming to prevent a price shock that could ripple through the consumer market. Foreign media have dubbed these behind-the-scenes efforts as Carney's broad coalition diplomacy, a testament to his strategic maneuvering to balance competing interests. The likelihood of the U.S. withdrawing its steel and aluminum tariffs remains uncertain, particularly in an election year, as Trump seeks to bolster his protective shield pledge for Rust Belt steelworkers in key battleground states like Pennsylvania and Ohio, where manufacturing jobs are a critical political issue. Yet, most of these facilities rely heavily on Canadian raw materials, not Chinese ones, undermining the U.S.'s national security argument. The American Iron and Steel Institute warned in a late June report that disrupted Canadian steel supplies could reduce U.S. domestic solid fuel blast furnace capacity utilization by 4 percentage points, leading to 4,200 job losses in Ohio and 3,600 in Pennsylvania, posing a significant risk to Trump's voter base. Ahead of the November elections, Trump faces a precarious dilemma. Protectionism may fuel short-term border wall rhetoric and appeal to nationalist sentiments, but it risks triggering unemployment and shifting voter preferences in critical swing states. The high-tech sector is also grappling with significant repercussions. Tesla plans to source Canadian aluminum for its Berlin cell factory, but the tariff war could inflate supply costs, potentially forcing the company to turn to lower-quality aluminum from Indonesia for its superpresses in Nevada, which would increase carbon content and jeopardize access to affordable financing tied to sustainability goals. Similarly, SpaceX's Starship program relies on Alcoa Montreal cast blocks for its high wear-resistant aluminum-lithium alloys, and retaliatory measures could drive up costs, causing fluctuations in space project budgets and complicating ambitious timelines. The World Trade Organization's role as a global trade arbitrator is increasingly challenging, with its appeals body gridlocked due to U.S.-blocked judicial appointments, leading to significant delays in dispute settlement rulings. Carney's planned WTO complaint, alleging misuse of Section 232, is likely to languish for years, leaving the issue to be decided amidst shifting political preferences. In response, Ottawa is pursuing a multi-pronged strategy, combining counter-tariffs, investment incentives, and diplomatic pressure to force Washington to reconsider its stance in the face of legal and economic deadlock. From a geopolitical perspective, the Canada-U.S. metal trade tension has broader implications, with China observing the discord within the Western Bloc as an opportunity to advance its own interests. Beijing views these internal contradictions as self-defeating, with the Chinese Ministry of Commerce official noting, "This benefits our ultimate market share in global trade." Meanwhile, Trump is banking on his America First slogan to resonate with voters at the ballot box, leveraging nationalist sentiment to bolster his re-election campaign. What are your thoughts on this high-stakes trade dispute? Please share your opinions in the comments section below, and don't forget to subscribe to our channel and turn on notifications to stay updated on this evolving story and other critical global developments.